All right, good afternoon, everyone, and welcome to our second Iowa SourceLink Iowa Department Revenue webinar for the year. Just taking a minute to let everyone get their Zoom webinar up and loaded. We're excited to have you here this afternoon with us as we talk about pass-through entity income tax overviews. My name is Patrick Linsman. I'm the director of the John Papajohn Entrepreneurial Center here at the University of Northern Iowa. And we work with the Iowa Economic Development Authority to bring the Iowa Sourcing platform to all Iowa business owners, whether anyone who works with, on, or for a business. We provide resources to help them get the up-to-date information on all things happening for business in Iowa. So with that, today, a couple housekeeping things. This webinar is being recorded, and the recording will be available at a later date within about 1 week. We've got a few of my team on the call today. Haley Ham is one of them, and she's going to be posting the link to the slides in the chat. So you can go ahead and download that PDF link to follow along with the content of today's presentation. If you do have questions throughout the presentation today, please put them into the question and answer box. Michael does have a lot of content to cover today, so we'll probably have limited time for Q&A, but anything that gets put into the Q&A box, we download and then send back to the presenter in the department to be able to help answer those questions, whether it be through an FAQ that we're able to share or directly answer your questions throughout it. For those questions, ones that we're able to answer during the webinar today are going to be pretty much general or broad. We're not going to be able to help anyone with their specific questions today. For those types of questions, you do need to contact the department directly. So with all of that housekeeping out of the way, we're excited to welcome Michael Mertens today with us, the Policy Director for Pass-Through Entities from the Iowa Department of Revenue. And we're going to be talking about the Iowa Pass-Through Entity Income Tax Overview. Michael, welcome, and thanks for being here.
Thank you, Patrick, and thank you, everybody, for sharing your lunch hour with the Department of Revenue. As Patrick mentioned, my name is Mike Mertens. I am the Policy Director for Pass-Through Entities here at the Department of Revenue. Over the next hour, I'm going to be talking about I'm going to give you an overview of the Iowa Pass-Through Entity Income Tax laws here in the state of Iowa. Before we get started, there is an obligatory disclaimer just to let you know that anything I say in this presentation can't be held against me or the department later. Only written binding advice issued pursuant to a petition for a declaratory order can bind the department. Just a quick overview of what we're going to discuss today. I'm going to provide you a very high-level overview of partnership and S corporation income tax requirements, composite tax requirements. We'll talk about the due dates, filing methods, and penalties related to those returns. And then hopefully, if we have time, we'll spend some time talking about amended returns and Iowa pass-through audits. Just a few things to keep in mind before we start this. This is intended to be a very high-level general overview of these income tax requirements in the state of Iowa. Some of the topics we'll discuss could fill an hour-long webinar all by themselves. And I was reviewing the content before the presentation, and it's a pretty ambitious agenda. So I'm going to need to move through the slides rather quickly because of time. I may not be able to touch every issue that's mentioned on the slides, but I do hope that the full information in this presentation is helpful to you later if you reference the slides. Another housekeeping issue, this presentation focuses generally on the current state of Iowa tax requirements. So what I'm really going to be discussing is tax years 2023 or later. Some of the requirements may have been different in past tax years. Also, estates and trusts, often referred to as fiduciary income tax, are generally considered to also be pass-through entities. And they are subject to many of the requirements we'll discuss today. But I just want to let you know that this presentation is going to focus on partnerships and S corporations. So estates and trusts are outside the scope of this presentation. And finally, just to let you know, we're focusing on income tax requirements today. But these pass-through entities may have other tax filing and remittance obligations with the state, including sales tax or wage withholding. So just keep that in mind as we move through the presentation. So before we begin, we need to establish what we mean by a partnership or S corporation. At the federal level, business entities have fairly wide latitude in determining how they want to be taxed for federal income tax purposes. Under the IRS's entity classification regulations, these are sometimes called the check the box regulations. The state of Iowa follows these check the box regulations. So for Iowa tax purposes, any entity, whether it's an LLC, a partnership, a limited partnership, or so on or so forth, any entity that elects to be taxed as a partnership or S corporation for federal income tax purposes will also be treated as such for Iowa income tax purposes. Occasionally, entities are wholly owned by another taxpayer, and when this occurs, they can sometimes be classified as disregarded entities for federal income tax purposes, which really just means the entity is disregarded as a separate legal entity, and all the activities of that entity are reported on the owner's return. This commonly happens for single member LLCs. Iowa also follows these disregarded entity statuses that apply for federal income tax purposes. If you happen to own a disregarded entity and you're reporting the activities of that entity on your income tax return, you would be required to file with your return an Iowa Schedule DE, which provides information to the department about that disregarded entity. As we go through this presentation, I'm going to collectively refer to partnerships and S corporations as pass-through entities. So I say we go ahead and just dive right in to income tax requirements here in the state of Iowa. The first question we need to ask ourselves is whether you have a requirement to file an income tax return. This is often referred to as nexus. Here in Iowa, any pass-through entity must file if it is doing business in Iowa. This includes any activity or transaction for the purpose of financial gain or pecuniary profit, or if they are deriving income from real, tangible, or intangible property located or having a situs here in Iowa. So tangible property can be in Iowa if it's habitually present here or maintaining a fixed or regular route through Iowa. And intangible property can be considered derived from Iowa if it has some integral part, if it constitutes some integral part of a business activity occurring regularly in Iowa. A few important notes here. There is no income filing threshold for pass-through income returns. Non-de minimis activity here in the state can create a filing requirement. In addition to that, physical presence is not required in Iowa to establish nexus. I would refer you to the KFC versus Iowa Corporation versus Iowa Department of Revenue case from the Iowa Supreme Court back in 2010 as an example. In that case, the Iowa Supreme Court ruled that a business can have nexus in Iowa for income tax purposes when its only connection to the state involves the receipt of royalty income from the licensing of intangible property like trademarks to third parties for use in Iowa. So please keep that in mind. There are a few statutory protected activities that may prevent the state of Iowa from imposing income tax on the business or filing requirements on the business. The first is Public Law 86-272, which generally restricts, it's a narrow law that restricts a state from imposing net income tax on income derived within its borders if the only business activity within the state is the solicitation of orders for the sale of tangible personal property. That's a very important distinction, as long as those orders are sent outside the state and delivered from outside the state. So it is an important restriction on the state's taxing power, but it is a very narrow one. In addition to that, Iowa Code Section 422.34a provides a list of certain activities that, if engaged in by a business, by themselves do not constitute doing business in the state to create nexus. A few examples of these may be maintaining bank accounts in the state, or utilizing Iowa courts for litigation. So if you do have a filing requirement, your income tax return package is going to include for both partnerships and S corporations an Iowa income tax return, which is the 1065 for partnerships, the 1120S for S corporations. This includes any required schedules or attachments. We'll talk about a few of those later. You're going to be required to submit an Iowa Schedule K-1 for each partner or shareholder, and a copy of your federal income tax return with your Iowa income tax return. So let's move into completion of the return. As a general rule, Iowa pass-through entities are not subject to income tax at the entity level. Instead, as the name suggests, these entities pass through their tax items to the owners, and they report their share of that income and deductions and pay any related income tax. These are referred to generally as distributive items from a pass-through entity. So that's the starting point for us to compute the tax base on an Iowa return. That's going to be your starting point is going to be your net federal Schedule K income from your federal 1065 or 1120S. So this includes things like ordinary business income. In the case of partnerships, it includes guaranteed payments, rental income, investment income, commonly referred to as portfolio income, like dividends, interest, capital gains. There are a number of items classified as other income that are included in the tax base. I apologize, the lights seem to have gone out, but we'll keep going. And this includes a number of deductions that are required to be separately stated to the partners or shareholders. One important exception to this is partnerships are not allowed or permitted to include any excess business interest expense that are reported to partners on the federal Schedule K box 13E. And the reason for this is because Iowa has decoupled from the federal business interest expense limitation. So those partnerships operating in Iowa are allowed a full deduction for their current year business expense, business interest expense that is computed on the Iowa 163. So because they're allowed that full deduction in the current year, those disallowed excess business interest expenses are not put into the Iowa tax base. There are a number of additions and reductions that are required or allowed under Iowa law. For a full list of these additions or reductions, I would refer you to Iowa Code Section 422.7 and 422.35, except for those Iowa adjustments that only apply to individuals. If you have a required or allowed addition or subtraction, these are all reported on the Iowa Schedule A, which is a supplement. It is a part of the income tax return. A number of these adjustments are separately identified on dedicated lines, and they may require supplemental schedules to compute the adjustment. If you have one of these specifically identified adjustments, you are required to report the adjustment on that specific line on Schedule A. And it's very important to avoid processing issues that you also include the required supplemental schedule with your return. The sum of these additions and subtractions will flow through from the Schedule A to the main return, your main income return. There is an other adjustment line on line 15 of the Schedule A. It's meant to be a catch-all for any adjustment that is not specifically identified on lines 1 through 14. Anytime you're claiming an adjustment on line 15, the other adjustment line, you are required to include an explanation of that adjustment with your return. I've got a list here of a few of the common additional or other adjustments that are allowed under Iowa law. I won't read through them, but I do want to mention quickly that under Iowa law, there are certain capital gain deductions that are allowed specifically to individuals. These capital gain deductions are not taken by the pass-through entity. They should not be reported on Schedule A. They are taken only at the individual level. If necessary, the entity can provide information about that individual level deduction on a supplemental schedule with the K-1 to allow the owners to appropriately claim that deduction. So if a business is operating in other states, the U.S. Constitution requires that we allocate and apportion its taxable income among the states. These are two separate actions. I'll describe them in more detail in a minute. But before we do that, we need to separate a business's income into business income and non-business income. Business income is an expansive term, really meant to encompass any income earned or sufficiently connected with the taxpayer's trade or business. This is the statutory definition of business income. I will not read through it now, but I do want to draw your attention to subparagraph 1, which says that it is the Iowa General Assembly's intent that we treat as apportionable business income any income that may be treated as such under the Constitution of the United States. So again, it's a broad definition. Business income is apportioned. Anything that's not categorized as business income is by definition non-business income and is allocated. Non-business income does not mean that it is income not earned by the business. All of this is income earned by the business. It's just a term of art applied to income that is allocated. So again, we've got these two terms, allocation and apportionment. Non-business income is allocated, which means we remove it from the apportionable tax base and we specifically assign it to Iowa or another jurisdiction. These non-business income claims in Iowa are reported on the Iowa Schedule D. When you're making a non-business income claim, you are also required to allocate any related expenses to that income along with the non-business income. It's fair to say that non-business income events are rare. So most of the time businesses should not have non-business income to allocate. Depending on the type of non-business income you have, it may be allocated to your business's commercial domicile, or it could be allocated to the state where the income producing property is located or utilized. So any income that is not allocated as non-business income is by definition business income. We apportion business income using a business activity ratio computed on Schedule E of the income tax return. So this is an Iowa percentage calculation comparing Iowa receipts to everywhere or total receipts. That comes up with an apportionment percentage that is applied to that apportionable tax base. All pass-through entities are required to complete this Schedule E, even if 100% of your business is conducted in Iowa. The state of Iowa uses a single factor for determining your apportionment percentage. Some states use multiple factors, but here in Iowa, we use a single factor, gross receipts. So there are 8 categories of sales or gross receipts that are included on the bar. On that last slide, you'll see them on lines 1A through 1H. They are separately stated because sourcing rules are different for each of these types of income. The most common type of receipt is sales of tangible personal property, which is generally sourced to Iowa if delivered or shipped to a recipient located in Iowa. Also common are sales of services, the gross receipts of which are sourced to Iowa to the extent the recipient receives the benefit of the service in Iowa. There are a number of different business activities with special sourcing rules, including transportation, telecommunication, broadcasting, media, utility, and financial activities. I'm not going to go through those here, but I just want to make you aware that those do have special sourcing rules, and you need to consult our administrative rules and the return instructions to determine how to source those to Iowa and other states. Businesses often earn things like investment income like dividend, interest, rents, royalties. To the extent that this investment income is considered business income, it must be included in that business activity ratio if the investment income is derived from intangible property that has become an integral part of the taxpayer's trade or business activity. Any other investment income that is considered business income may be included or excluded from that business activity ratio at the taxpayer's election. There is no special form to make this election. It is simply elected by when you file your initial return with the state, by either choosing to include or exclude in that bar calculation this investment income. That constitutes your election. That election is binding on all future tax years unless permission to change is granted by the director. Occasionally, a pass-through entity can be a member of another pass-through entity and receive distributive income. When that occurs, if a pass-through entity's distributive share of income from another partnership is considered business income, then the pass-through entity's share of gross receipts from that partnership are included in its own business activity ratio. There is a dedicated line on the bar calculation to report these gross receipts, and they will be reported to you on an Iowa Schedule K-1. We've got a screenshot here, so you should receive both your share of the Iowa receipts and your share of the everywhere or total receipts from that other partnership to report in your business activity ratio. So that's a general overview of the statutory methods for allocation and apportionment. Iowa law does allow a business to petition the department for permission to use an alternative allocation and apportionment if that statutory method would result in an injustice. In order to qualify for that alternative, for us to consider your alternative apportionment requests, you must first file your Iowa return using that statutory allocation method, and then request the alternative method afterwards. These requests can be submitted on paper or through login on GovConnect Iowa. Iowa provides, I'm going to shift a little bit now and talk about tax credits. Iowa provides a number of tax credits that can be earned or received by pass-through entities. Most of these tax credits are going to be reported on the Schedule B that's included on the income tax return. We'll talk about a few exceptions in a moment, but I want to walk through the mechanics of reporting Schedule B tax credits. Each tax credit you either earn or receive should be reported separately on this Schedule B before you allocate those credits to your owners on Schedules K-1. Each Iowa tax credit is assigned a unique tax credit code. They're all available in our instructions. Make sure you complete the Schedule B by using not only the correct tax credit code assigned to that tax credit, but also if it's an awarded tax credit, meaning another state agency you had to seek permission first to claim that tax credit, usually through an application process. You're going to receive a tax credit award with a unique certificate number. That certificate number needs to be included on the Schedule B to avoid processing issues. There are also a number of Iowa credits that we refer to generally as automatic credits, meaning no application or award process is in place before you can claim the credit. If you meet the requirements, you can complete the supporting tax credit schedule, for example, the Iowa 128 Research Activities Credit Form, and include it with your return. Be sure to include both the supporting tax credit schedule and report the amount of the credit on Schedule B with your return to avoid processing issues. Both your income return with a completed Schedule B and any supporting tax credit schedule must be filed with the department before your owners can claim their allocated share. Otherwise, there could be processing issues. So again, make sure you get that income return filed before your owners file their allocated share. So a few exceptions to the Schedule B reporting. First, composite credits and pass-through entity tax, often referred to as PTET credits. We're going to talk about these in a little bit, but to the extent that a pass-through entity earns these credits, they are reported on Schedule K and Schedules K-1. instead of being reported on Schedule B. Similarly, if the entity receives a composite or PTEC credit from another entity that it's a member of, these tax credits are retained at the entity level. They are not further allocated to owners or reported on Schedule B. The entity reports or claims these credits directly on their income tax return, the 1065 or 1120S, or on a qualifying composite return, and can receive a refund since they're refundable credits to the extent that the credit exceeds their tax liability. Again, these credits are not further allocated to owners once you receive them from another entity. Iowa provides an S corporation apportionment tax credit to resident shareholders that is computed, that essentially allows a resident shareholder to apportion income from a pass-through entity outside the state to the extent that it was earned outside the state from that S corporation. So the S corporation apportionment credit does require you to use the Iowa Schedule K-1 to compute it, but it is not reported on the pass-through entity's income tax return. Instead, those resident shareholders use the information on their Schedule K-1 to compute the credit and submit the Iowa 134 tax credit schedule on their own 1040 or 1041. Often, banks operating in Iowa are organized as S corporations. And when that occurs, the S corporation is required to file both an income tax return and pay franchise tax on a franchise tax return, the 1120F. When that happens, to avoid double taxation, Iowa offers a franchise tax credit computed on the Iowa 147 to the owners of that S corporation bank, according to their share of the franchise tax paid by the S corporation. Again, this is related to S corporation activity, but this credit is not reported on the pass-through entity's income tax return. Instead, the S corporation is required to include with its Schedule K-1 to the owner information described in the 1120S instructions that would allow that owner to complete their Iowa 147 and claim their own franchise tax credit. All right. I mentioned earlier that the general rule, as you're probably aware, is that pass-through entities are not subject to income tax at the entity level. There are, however, a few exceptions to that. The first is for S corporations who can be subject to what's called built-in gains or passive investment income tax at the federal level under IRC section 1374 or 1375. When an S corporation operating in Iowa is subject to those taxes at the federal level, they are also subject to Iowa corporate income tax on that same income to the extent it is sourced to Iowa, and that tax is computed directly on the 1120S return. In order to compute that tax, there are a few calculations allowed to the S corporation, the first of which is the S corporation can use any unexpired and unused net operating loss carry forward from a year that it was a C corporation against these entity level taxes. The Iowa corporate income tax rates apply to this income. So if you were reporting income in 2023, you would have used the 5.5% and 8.4% rates depending on the amount of income you earned. There are a few tax credits that can be used to offset this entity level tax. The first of which is any unexpired or unused Iowa tax credit carry forward, again, from a year that the S corporation was a C corporation, or any of those PTED credits or composite credits that the entity has received from another pass-through entity. I think I mentioned before, anytime you're claiming these credits on a return, you need to report them on a Schedule CC and include that Schedule CC with your return. Those are the only credits available against these entity level taxes. This does not, this calculation does not include any of those Schedule B credits we talked about earlier. Those are further allocated to shareholders and only claimed by the shareholders. Another fairly recent addition to entity level income taxes is the pass-through entity tax, or PTET as we call it. This was just enacted a few years ago, so again, it is a fairly new development here in Iowa. I'm not going to go into a great level of detail on this tax simply because we have already posted detailed guidance available on our website in addition to previous webinars. So I would refer everybody to that for some detailed information about the PTET, but I do want to walk through some of the basic mechanics. The first of which is that this is a voluntary election for the pass-through entity to be subject to Iowa income tax at the entity level. So this election is irrevocable, but it only applies to one tax year, and it must be made by someone with the authority to sign the entity's income tax return and bind both the entity and its owners for income tax purposes. There are two methods to make a PTET election. The first of which is directly on GovConnect Iowa through a login. There is an election form available once you log in. That election form only records the election for a particular year. It does not compute tax. That tax is still computed directly on the income tax return. The other method is to directly make the election on your income tax return via a checkbox that I have a screenshot of here. So those are the two methods for making a PTET election in a year, if you choose to. The actual tax calculation for the PTET is fairly straightforward. It is the pass-through entity's Iowa source distributive items, which we discussed earlier, multiplied by the top individual income tax rate for the year. So if you made a PTET election for 2023, you would have been paying the 6% top individual rate against that income. When you make an election and compute this tax, all of your owners' distributive income must be included in the calculation. The entity is not allowed to exclude certain owners, nor is the entity allowed to claim any net operating loss or other owner level deduction against this PTET. There are a few tax credits available to reduce your PTET, the first of which, as we've mentioned earlier, are those PTET credits or composite credits that the entity received from another pass-through entity that are retained at the entity level. Similarly, if an S corporation bank that has paid the franchise tax is also making a PTET election, it is allowed to claim as a credit against its PTET the franchise tax it paid for the same tax year. And as you're sensing a theme here, this tax calculation does not include any of those Schedule B credits we discussed earlier. Again, those are all only allocated to shareholders or partners and claimed by the shareholders or partners. As far as impact on the owners, when the PTET is elected, all of the owners receive a percentage of that net PTET that is due as a refundable tax credit. This credit is computed by taking the net PTET due minus the applicable tax rate for the year. So for those that made a PTET election in 2023 and paid the 6% rate, your owners would receive 94% of that tax due as a PTET credit for the year. These PTET credits are claimed by owners on the Iowa return for the same tax year that they're also reporting that related K-1 income from the entity. And an important thing to remember is that all of your owners are still required to file, when you make a PTET election, all the owners are still required to file their Iowa income tax return and report their distributive income from that pass-through entity. There is one exception, and that is for a non-resident individual owner whose only Iowa source income for the year is from one or more electing pass-through entities. And if their PTET credits equal or exceed their Iowa tax liability, they are relieved of the requirement to file an Iowa income tax return. However, they are not prohibited from filing an income tax return. In fact, they may choose to file an income tax return anyway because their credits might exceed their liability and they are due a refund. So that is the general impact on owners when a pass-through entity makes a PTET election. So both of these income taxes I described, both the net built-in gains and passive investment tax and the PTET, can create an estimated income tax payment requirement for the partnership or S corporation if the net tax due will exceed $1,000 for the year. Please note that if you're making a PTED election for a tax year that begins before May 10th, 2023, you are not required to pay quarterly estimates. So for a lot of taxpayers, their quarterly estimated payment for making a PTED started at tax year 2024. We'll talk a little bit later about the due dates and underpayment penalties related to estimated income taxes, but generally speaking, pass-through entities that are required to make estimated income tax payments follow the corporate estimated income tax rules. We've still got a lot to cover, so I'm going to speed up a little bit here, and I hope that you can get some of the substance of this later from reading the slides. But the income returns also include a Schedule K, which is really a restatement and a summary of the pass-through entities distributive items and how those items are allocated and apportioned to Iowa by category. This is also where the pass-through entity is going to report its total composite credits and PTED credits due to owners. Related to that Schedule K is the Schedule K1 for each owner. This is required for each owner who receives distributive income from the entity for the year. The sum of all the Schedules K must tie in to the amounts reported on the pass-through entity's income return. And just very quickly, there are two columns in the Schedule K1. You're going to report the total or federal amounts in column A, and then you're going to report the Iowa source amounts in that column B. And then, of course, that Schedule K is also used to report each owner's share of composite or PTED credit they earn, or any Schedule B tax credits they earn. So that is very quickly a summary of the Schedules K and K1 for the pass-through entity returns. Let's move on and talk about composite tax returns. Because for some pass-through entities, their income tax filing requirement does not stop at the income tax return. You may have a filing requirement for a composite return if you have one or more non-resident members. If this occurs, this filing requirement to file a composite return is mandatory. It is not elective. That's very important to keep in mind, because in past years, the composite return in Iowa was elective. Who is a non-resident member, I should say? This is what triggers your composite return filing requirement. A non-resident member includes any non-resident individual or any business entity, such as a partnership, S corporation, or C corporation without a commercial domicile in Iowa, or an estate or trust without a situs in Iowa. So if you have any of those non-resident members in your pass-through entity, you may have a composite return filing requirement and tax remittance obligation. Remember that any member who the entity does not know their state of residence, commercial domicile, or situs is going to be considered to be a non-resident member. So it's important to get that information from your owners to determine whether they are non-resident members, because the default is they are if you don't know. There are several exemptions from filing a composite return, even if you have non-resident members. I'm not going to list them or read them all here, but I'll direct you to the last two in this list because they're the most common. First, if a pass-through entity is making a PTED election for the year, it is relieved of its requirement to file a composite return. So you don't have to file both. It's an either-or situation. And then also, if none of the pass-through entity's non-resident members have positive Iowa source K1 income for the tax year, that will also relieve you of the requirement to file a composite return for the year. Again, there are other filing exceptions, but those are the two big ones I wanted to mention. I want to kind of breeze through the completion of the composite return just to give you a general idea of how it is computed. It is a fairly simple and short return to complete. The most important piece of the composite return is the non-resident member schedule. This is where you're going to report information, income, and tax due for each non-resident member. One of the most important columns in this schedule is the column F, where you're going to report, if applicable, tax payment exemptions for qualifying non-resident members. An example of this may be an insurance company who is a member of a past serenity is exempt from the payment requirement, but not the reporting requirement, and that is because insurance companies do not pay income tax in the state of Iowa. The other big exemption from composite tax payment is the code NMA, which is for entities, I should say, it's for non-resident members who elect out of the composite return tax payment requirement using that non-resident member composite agreement. Here's a screenshot of that composite agreement. It is available on our website. In order to be valid, this agreement must be signed by both the non-resident member and the past serenity prior to filing the return for the year. This agreement is not filed with the department. There is no requirement to send it to the department unless we ask for it. So please keep it with your entity's records in case we ask for it, but there is no requirement to send it in. And it is an annual form. So if a taxpayer or a non-resident member desires to elect out of the composite return tax payment requirement for a particular year, and they want to do it again in a later year, they need to execute an agreement for that year as well. This agreement essentially is a legal agreement between the entity and the owner, whereby the owner is providing assurances to both the state of Iowa and the entity that it will file its Iowa income tax return and pay the tax that is due from its income earned from the entity, because and thereby it relieves the entity from the requirement to pay composite tax on behalf of that member. So I mentioned that composite tax, that's going to be computed on in columns G, H, and I. If there is no applicable exemption code, then you're going to compute this row for each column. The non-resident members' composite tax due is the Iowa Source K1 from the Iowa Source income from the K1, which is the sum of those column B amounts generally, not including tax credits, multiplied by the top rate applicable to that owner for the tax year. This could include the individual rate if it's an individual or past serenity, the top corporate rate if it's a C corporation non-resident member. So use that applicable rate multiplied by the owner's Iowa Source K1, and that gets you the composite tax due for that applicable member reported in column I. So the sum of all of those amounts from that non-resident member schedule, the tax due, will then flow through to the first line on the composite return. And that is the entity's composite tax due on behalf of those non-resident members. That is the tax remittance obligation. The entity is allowed to claim any PTET or composite credit it received from another entity against that composite tax, but that is essentially the tax computation on the composite return. Quarterly estimated payments are not required for composite returns. That's very important to remember. The tax is due with the return. Similar to the PTET election, when a composite tax is paid on behalf of a non-resident member, the non-resident member receives a refundable credit for their share of the tax paid that credit is reported on the K1. It allows the entity to claim, or the non-resident owner to claim those composite credits on the same return that they're reporting the related K1 income. And again, generally, any owner that has composite tax paid on their behalf does still have an Iowa tax return filing obligation and a requirement to report their distributive income from the past serenity, except for those non-resident individual owners whose only Iowa Source income is on composite returns, or if they're below the filing threshold. So let's roll forward here to talk about the due dates, filing methods, and penalties related to these returns. Both the 1065 and the 1120S are due at the end of the fourth month following the close of the tax year. For calendar year filers, that's going to be April 30th. Iowa provides an automatic extension for 6 months to file the return if at least 90% of the return tax, if any is due, is paid by the original due date. If it's a pass-through entity that doesn't owe any tax, then it automatically qualifies for that 6-month extension. The composite return, if you have a composite return filing requirement, the due date for that return follows the income tax return, and it's always due at the same time, including extensions if applicable. The PTED election we actually discussed earlier does have a due date, and it's very important to keep in mind because failure to abide by that due date can result in the PTED election being disallowed. So the PTED election must be made by the due date of the income tax return, including extensions. That can create some interesting scenarios if you plan to make a PTED election on an extended return. It's very important if you want to preserve your ability to make a PTED election during that 6-month extension period, you must pay 90% of the tax due by the original due date in order to be able to do that. Or to avoid that scenario, you can make an election on GovConnect Iowa before the original due date, and that preserves your right to make the election on an extended return, even if that return is later considered late. Now I have an example here on the slide that kind of illustrates what can occur if you try to make an election on an extended return. I won't go through it here, but I would encourage everybody to read through it later to see what can occur if you're not careful with your PTED election due date. There are penalties imposed under Iowa law for late filing of returns. Generally, the penalty is 5% of the unpaid tax if you don't pay 90% of the tax due by the original due date. However, for entities filing a 1065 or 1120S, you can be subject to a late filing penalty, a monetary late filing penalty, even if you don't have any tax due. Under Iowa law, there is a 5% late file penalty applied against your imputed Iowa tax liability, which is a statutory calculation that computes what your penalty would be if you would have owed tax, and imposes that penalty even though you didn't owe tax but you filed the return late. So I want you to all be cognizant of these return late file penalties because they can be imposed even if you don't owe tax for the year. Certain pass-through entities have electronic filing mandates. If you meet certain thresholds, which I have listed on the slide here, you will be required under Iowa law to file your return using the IRS MEF portal. If you have a partnership or S corporation income tax return e-filing requirement for the year, you are also required to e-file your composite return. And there are some pretty serious consequences for failing to abide by this e-file requirement. Improperly filed returns under Iowa law are treated as non-filers, which can subject you to late file penalties and an unlimited statute of limitations for the additional assessment of tax. So keep that e-file mandate in mind if it does apply to you. Even if it does apply to you, there are certain instances where an e-file exception can be granted for good cause. I've got a few of those good causes listed here on the slide, but I do want to point out that inadequate tax preparation software is not considered a good cause. In order to request that e-file exception for a particular tax year, you are required to submit an electronic filing request exception form, which is available on our website. The form must be submitted before the time you file your income tax return. It can be submitted online, on paper, through email, or it's now available to be submitted on GovConnect Iowa. The department will respond in writing to your request, either approving or denying it. If we don't respond within 90 days of submission, it is deemed accepted. Those are generally the return due dates. Payments also have a due date under Iowa law. If you have any return tax due with your pass-through entity return or composite return, it is due by the original due date of the return, not including extensions. If you fail to pay the full amount due by the original due date, you will incur a late pay penalty of 5% of the unpaid tax if you did not pay 90% of the tax due by the original due date, and you can incur interest from that original due date. So we talked earlier about the requirement to make estimated tax payments for certain entity level taxes. These are due on the 4th, 6th, 9th, and 12th months of the tax year. Remember, there is no estimated tax requirement for composite tax, so I'm only talking about PTET and that built-in gains or passive investment tax. If you fail to make these timely payments, underpayment penalties may apply. These underpayment penalties are computed on the Iowa 2220 form, and that form does include a number of exceptions, a few of which I have listed here, but I won't read through them. I would just request that you consult that form for more information about those underpayment penalty exceptions. All right, we've got about 10 minutes left. I want to see if we can get through the rest of this, but maybe not. I do want to talk a little bit about amended returns. Under Iowa law, the general rule is there is a duty to amend your income tax return, including your K-1s and your composite return, if you discover discrepancies or errors. Whenever you amend your income tax return, you are required to submit that Iowa 102 amended return schedule with your amended return. But there are a few limitations to this general rule. The first is generally under Iowa law, a pass-through entity is restricted from filing an amended income tax return 3 years after its original filing. There are some big exceptions to this if you're reporting federal amended return changes or federal or Iowa audit changes, but that is the general rule or the general limitation to filing an amended return. Amended income tax return. Similarly, or I guess additionally, a composite return is not required to be amended if the only change would be a decrease in the Iowa source income reportable to one or more non-resident members. And this is because a pass-through entity cannot request a refund of composite tax paid on behalf of a non-resident member. Iowa law treats that composite tax once paid as paid on behalf of the non-resident member. So only that non-resident member can seek a refund on their individual income tax return. There are some unique considerations we need to discuss when we're talking about amended returns and the reporting of federal partnership return changes. Under federal law, most partnerships are under what's called operate under what's called the Bipartisan Budget Act. They're often referred to as BBA partnerships. And these partnerships generally don't file amended returns. Instead, they file administrative adjustment requests. And they're also subject to these centralized entity level audits. And what's interesting is when there is a change from either an administrative adjustment request or an audit at the federal level, generally speaking, any additional federal tax that may be due from that change is paid by the partnership instead of the partners. And any negative adjustments or decreases in income are generally reported to the partners on a current year federal return. All of this is to say that generally partners don't have a requirement to file amended federal returns when changes occur to a partnership return under this Bipartisan Budget Act. However, there is still a requirement under Iowa law to file amended Iowa returns to report these changes. And that is true even if the partners are not required to file amended federal returns or pay any additional federal tax. And there are certain reporting deadlines that I want you to be mindful of. I'm not going to discuss them here, but they are available on our website or in Iowa Code 422.25. But the main point I want to get across is you may have an Iowa amended return filing requirement both at the partnership level and on the partners even though you don't have a federal amended return filing requirement when you have one of these partnership changes. The department has an additional year to assess tax stemming from one of these partnership changes, measured from the date you file a complete amended return with the state of Iowa. So if the partnership and or one of its partners do not amend their returns as required, that additional assessment period is unlimited for the department. So it's important, again, to be mindful of those reporting deadlines and to report those partnership changes if they occur, even though you may not have an amended return requirement at the federal level. If in the case of a partnership audit that results in a refund of tax, that refund can be requested within 1 year of your reporting deadline. So I want you to be cognizant of that. And then there's another unique, or I guess fairly new area of law, Iowa law, which allows partnerships who are reporting federal partnership audit changes to the state of Iowa to make an election to pay on their owner's behalf, which would then relieve those owners, the partners that is, of their requirement to file an amended return. So this is made on the Iowa 103 audit election to pay. It's an irrevocable election. I'm not going to go through all the requirements here, but I just want you to be aware that if you are reporting federal partnership audit changes, there is an ability for the partnership to make an election to pay on its owner's behalf. That would then relieve the entity of the requirement to issue amended Iowa K-1s and have the owners file amended returns and pay additional tax. All owners are required to be included in this election to pay if you make one. And again, it's calculated on the Iowa 103, and there is a checkbox and a reporting line on the 1120S or 1065. 3 minutes left, but I would like to just very briefly touch on Iowa pass-through entity audits because the rules related to pass-through entity audits and how they're conducted have changed fairly recently. If you have a pass-through entity who is subject to either an audit or exam by the Department of Revenue, Iowa law requires that this audit be conducted and determined solely at the entity level. The person that is designated as the pass-through representative on the Iowa income tax return is the person who will act on behalf of the pass-through entity during that audit. The owners of the pass-through entity have no inherent right to intervene or participate in the audit, but they are bound by the results of the audit or the exam. And these rules apply to all partnerships and S corporations in the state of Iowa. There is no owner threshold or election out like there is at the federal level. So this is a fairly new development for how audits are conducted in Iowa for pass-through entities. The Department of Revenue is generally required to review and adjust a pass-through return, an income return within the statute of limitations for that applicable income tax type. So generally, we're talking about a 3-year statute of limitations to audit or examine a pass-through return. There are certain exceptions to that. If the department makes adjustments to the income return that affect K-1, so if we're talking about changes to distributive items here, the department will issue what's called a final notice of adjustment to the pass-through entity. This will only go to the pass-through entity. The owners will not initially receive tax bills, nor will the owners of that entity be required or allowed to file appeals related to that. The resolution of those adjustments are determined and happen only at the entity level. And the entity could also receive a tax assessment if it owes tax penalty or interest under another provision of law. But if it gets one of these final notices of adjustment, it must take action. So please pay attention to them if you get them. If the entity disagrees with the adjustments, it must file an appeal within 60 days. Failure to file an appeal makes those adjustments become binding on the entity and its owners after 60 days. And then following resolution of those adjustments, whether through agreement, appeal, or failure to appeal, once they become final, they are treated in the same manner as those federal partnership audits I described earlier. which generally requires it places the responsibility to resolve those adjustments on the pass-through entity. So the entity is required to file an amended income return either with K-1s or an amended return without K-1s, and it can make an election to pay on its owner's behalf. So that is just a very broad general overview of the Iowa pass-through entity audits. I didn't get through everything I wanted to talk about, but we are at time and we are at the end of the slides. So thank you all very much for your time today.
Yeah, Mike, great job. A lot of content. For those that did ask questions, I have those recorded and we'll make sure I share those with the department. If you do have specific questions, you can always contact the Taxpayer Services IDR at iowa.gov. Also, be sure to go out and subscribe to all of the variety of updates that all the different parts of the department offer through different newsletters and things. Subscribe to those. And be sure to follow them on social media, as well as Iowa SourceLink. We have our next presentation coming up on August 14th. It is the legislative update, so be sure to register for that. Otherwise, have a great rest of your July. The recording of this presentation will be sent out to everyone who attended or missed it next week. And thanks for being here. Mike, thanks again.
Thank you.
All right,
Bye.
take care.